Excellent. All right. Well, everybody, welcome to the Parr McKnight Investor Series with Don Luskin. Those of you that have been clients for a while know Don. I think we've had a multi-year engagement with Don. I always appreciate his keen insights. I want to first start by thanking everybody for those that are attending here for attending our last webinar. And Don, I think you were on that webinar as well with a former coworker of yours, Matt Hogan. We've had over 200 views on our YouTube channel. And that includes the attendees. So we call that a success, and we tried to demystify crypto for everybody. So thanks for taking an hour of your lives and being with us then and today. Joe, you can fire up the slideshow, and we can hop right in. There's a lot going on in the world. We're going to get to Don in a second. We'll talk about interest rates and the market and tariffs and the debt and the conflicts going on around the world and get Don's keen insight on that. But I wanted to, Joe, if you could advance to the slide with our headlines for our clients. We've got some interesting things cooking here at Parr McKnight. We went fully independent about 9 months ago and have been rolling out enhancements to our client experience. And I wanted to share with you a few of them today. We're actually improving our online access and going back to the Wells Fargo platform. That'll happen at the end of July. And a couple things to note there. Everybody, if you have bank accounts or checking accounts or lending products through Wells Fargo, those have been cut out previously. Now they will be added back in for a more holistic view of your entire investment landscape. We're also going to have something that a lot of clients have been asking about, which is enhanced security for your account. We will be employing multi-factor authentication to add security to the account. And also we heard a few grumblings about how the password was difficult and you couldn't reset it. Well, that's being solved as well. So look for more information on the new banking integrated Wells Fargo website. We'll be using the Wells Fargo mobile app also, but the website will be branded Parr McKnight, but it's actually that old website that clients were used to. And the Wells Fargo app, again, will now include multi-factor authentication and a complete view of investment, banking, and lending products from Wells Fargo. In the middle of your screen, you see FP Alpha, part of the new technology tech stack that we're unfolding for clients to enhance the experience and elevate the way we work with you. We'll be using FP Alpha, which is an AI-generated software or AI-assisted software to help you analyze your tax return, to come up with tax strategy and tax savings ideas. We've been rolling that out on a beta test basis and a lot of good feedback from clients. They also have an estate planning tool where we can scan your estate planning documents and look at the dispositive provisions, look at who's getting what, look at state and federal tax liability, and come up with strategies to help minimize not just current taxes, but the taxes that you may pay over a lifetime. I'm going to go to the right-hand panel. eMoney, if you're a client, you have a plan. We use what I think is the state-of-the-art financial planning tool in eMoney. And now they're going to have an enhanced client portal. But what's more important than that is they have an eMoney mobile app, which gives you an incredible view of all of your financial data, all the accounts that you've aggregated, all of the connected accounts that you've put in. So everything's going to be in a secure app on your phone with eMoney. So a couple great upticks there. I recently moved and I placated my wife with our financial plan by bringing it up on our phone. And she felt a sense of peace seeing our comprehensive financial picture in one easy to understand place. Joe, you can move forward. I promised, well, this is, again, how you access your financial data through Parr McKnight. And what I'd like to point you to here is in the upper left-hand corner, you see in green the word login. So we wanted to create one financial gateway where you could get all of your financial information. Now, these are all separate services with separate usernames and separate passwords, but you can access it through this page on the Parr McKnight website. The first tile says custodian access. And as you know, when we became an independent company, we maintained custody of your assets at Wells Fargo. This is that traditional view where you can grab a statement, you can change your statement delivery preferences, grab tax documents, look at your holdings, and unrealized gains or losses, some fairly rudimentary performance data. All that happens behind that first purple tile called custodian access. I just referenced eMoney and our planning tool, that the financial dashboard. To go online to that tool, which might be a better viewing experience than on your app, but to go online, you can click there. Although you can see your portfolio through the first tile, we've got a specific portfolio portal through a company that we retained called Orion, and we can slice and dice your investment results in 17 different ways. I know we've got plans to push some very informative reports that deal with your results into this Orion portal. So if you haven't taken a peek at your accounts there, one of the things that we've done recently is we've begun combining different accounts with different strategies into one account. And when you want to see how your different strategies are doing, the Orion portal is the best place to go. The last tile is the Giving Center. We do like to encourage our clients to share their blessings through charity, philanthropy, and we have a privately branded, a donor-advised fund, and you can access it there through that fourth tile. Look at your balance, look at how that account is invested, look at the charities that you've given to. It's a real simple and streamlined approach to philanthropic giving. So there's the financial gateway. I promised a quick investment update. Parr McKnight, we keep it really simple: stocks, bonds, cash. And I'm just going to run around the wheel. I can't give you any specific performance on these portfolios because clients are adding money and taking money out at different times. They may have portfolios that were put in place a while ago. And the main reason I can't talk about specific results is because the SEC, which is our governing body, prevents talking about results in this type of format. So I'll simply start with slice number one. We offer clients a dividend stock portfolio. It's between 40 and 60 names. Companies you mostly recognize, like Walmart and Procter & Gamble and Microsoft. These companies pay a dividend, raise them over time. They typically play good defense in bad markets and grab a piece of the up markets when we're blessed with a bull market. So the second tile, or the second slice, is the global dividend payers. A similar strategy, but that's where we get some international exposure. And after a number of years of underperformance in the international markets, that strategy, piece number two, is leading the way for clients right now with a nice high single-digit return this year. For clients that like to have a little sprinkling of maybe a 65-mile-an-hour portfolio, they're invested in our focus stocks, and that's where things like NVIDIA ride up against Berkshire Hathaway and JP Morgan. It's a more concentrated portfolio that is specifically designed to beat the S&P 500. Mission accomplished this year and last year with the focus portfolio. An area of, I believe, unrecognized opportunity, and one of the most statistically cheap areas in the market, are small and medium-sized companies. That's tile number four. Clients have dollars invested there as well. Piece number five to the pie are basically very well allocated portfolios invested in something near and dear to Don Luskin's heart, which are index funds. We offer a lot of diversification, simplicity, low expense, and transparency with those portfolios. That's a nice complement to many client portfolios. And number six is really the bedrock, the foundation of a lot of portfolios, is our fixed income strategies. These are bonds. They're mainly high quality, intermediate to long-term tax-free bonds and short-term treasury bills. So if you have an allocation to bonds, it's typically through tax-free bonds and treasury securities. By and large, the three comments I'd make are: in the drawdown this year, when we had triple T, which is what I call the Trump tariff tantrum, the S&P was down almost 20% peak to trough. Our portfolios played excellent defense. Like I said before, they're all ahead of their benchmarks this year with international leading. One more comment on our portfolios. These are mostly individual securities in these portfolios, individual stocks and individual bonds. And it allows for some tax efficiency with the portfolios where we look at these a couple times a year. And if there are losses to harvest to get some tax advantage, we will do that on behalf of clients and stock the tax loss bank account to offset future gains. Some clients have also taken advantage when we have a position that's up in value. If they're philanthropically minded, we can extract that security from the portfolio rather than sell it and make a contribution to a charitable account, thereby getting a deduction on the entire position and not selling it and paying capital gains. So our strategies are simple, transparent, and cost effective, and we're very pleased with the way they're working this year. So that was the housekeeping and the headlines. On to the main show. We've got Don Luskin with us today. He's been with us long enough. He doesn't need an introduction, but I'm going to give one anyway. Don is the CIO of TrendMacro. He was the CIO of Barclays Global. If you have a 401k at work, chances are you're taking advantage of Don's patented invention. He actually invented target date funds, those funds that adjust themselves in their mix as you get closer to your goal. Don's been advisor to 2 presidential candidates, and you'll see his thought leadership in the Wall Street Journal, Fox Business. He's on CNBC from time to time. He's written in the Harvard Business Review. Don's clients are the brightest minds on Wall Street. I always say we probably slipped in the back door. And I like 3 things about Don. He is not a two-handed economist. We hear these guys all the time. On one hand, I believe this, but on the other hand, this could happen. Don's got opinions. He's not afraid to say them. And he really runs independent of the mainstream media. I think even the editorial page of the Wall Street Journal has been quite watered down. And most of the time, you gain greater wealth by doing the opposite of what you see in the headlines in the mainstream media. And like I said, Don's opinions are backed by very strong data. So we don't have to give him a hand, but just let's welcome Don. Don, there's a lot going on in the world. I just want you to go through your stuff. Pause every once in a while. I might have a clarifying comment, but thank you for being here and welcome.
Oh, thank you. What a great privilege to be here. And you don't need to use the back door anymore, by the way. So, it's we're now almost halfway through the year, and if you were to just look at the headlines, you'd think we'd been through about 10 years of economically significant things going on that affect your portfolio. We've got stuff going on with tariffs. We've got stuff going on with immigration. We've got stuff going on with tax legislation. Any one of those would be very meaningful economically. We now, in the last 4 or 5 days, have major geopolitical events unfolding in the Middle East, where an awful lot of the world's oil comes from. So this has been an incredible time. And Tony, you're absolutely right that in the middle of this year to date, we experienced a little bear market. In fact, if you take the very high tick on February 23rd of the S&P 500 and compare that to the very low tick intraday on the very bottom of April 7th, just 6 weeks later, it was 21.4%. That's a bear market in anybody's book. It just took a very short time, and we've now substantially recovered. In fact, on a year-to-date basis, the S&P 500 is up a couple of percent. And if you take the Magnificent Seven out, it's up about 6%. Now, you can't take the Magnificent Seven out. That's part of the equity world. But there are, 7 very special stocks that are invested in a single wonderful new technology, artificial intelligence. And stocks like that do go through speculative corrections that sometimes the general market doesn't. So it's analytically useful to take them out. And if you do, for all the uncertainty, for all the volatility, for all the hand-wringing, for all the headlines, stocks are up year to date. It's really quite a performance. Now, probably the biggest economic threat on the bad side of the equation, the thing that's probably led to that bear market, is tariffs. Now, I encourage you, when you think about tariffs, Don't get involved in history books and think about the 1930s and the Smoot-Hawley Tariff Act and, all this stuff. Tariffs are just taxes. They're just taxes. They're like sales taxes, but they're special sales taxes. They're a sales tax you pay when you buy something from overseas. So if you're a big importer like Walmart, well, you're going to have to pay a tariff when you pay a tax when the ship arrives with a lot of stuff from China that you're eventually going to put on your shelves. Tariffs are taxes. So we can analyze the impact of tariffs the same way we analyze the impact of taxes, which is to say, we can just look at the dollars and cents. Now, if all the tariffs that Trump wants to do fall into place, the total tax hit will be a little bit more than 0.5% of gross domestic product, 61 basis points of GDP. So that makes it very comparable in its impact to the tax hikes that were put through in the first year of President Clinton's presidency in 1963, almost identical to that. It makes it less than the tax increase that happened in 1982, which was the largest peacetime tax hike since World War II. That was the so-called TEFRA Act. That took out a whole 1% of GDP. This is not that big. Neither the 1993 tax hike nor the 1982 tax hike, both of which were bigger, one considerably bigger, neither of them caused a recession. So I believe that generally speaking, tax hikes are not pro-growth, but that isn't to say they cause a recession. And we've had bigger ones that didn't cause a recession. Now, with these tariffs, remember that 61 basis points of GDP that I said would be the tax cost of these tariffs, that's if they get full implementation. Well, the courts have gotten involved. Now, I'm sure you've all been watching the headlines ever since Trump has taken office. He's had a lot of executive orders having to do with immigration and regulation and government grants to Harvard and lots of stuff. And I'll bet some of it you love and I'll bet some of it you hate. But there's been a lot of it, and an awful lot of it has been enjoined by federal courts. So he's issued the orders, but they can't be implemented because they're under injunction by a federal court. Now, if you're in favor of all these things that Trump is trying to do, you're saying, well, how can these federal courts get in the way like that? There are 9 districts in the federal court system, uh, and some of them are in conservative places like Texas, and some of them are in liberal places like California and Hawaii and Oregon. And if there's something Trump does that you don't like, well, you're going to file your suit not in Texas, you're going to file your suit in Hawaii. And so there are judges sitting in Honolulu that issue injunctions from their district that shut down these executive orders for the whole country. Now, if you don't like those executive orders, you're really happy about that. But here's the problem. Democrats are filing those suits, shopping for judges who will help them to shut down Trump's initiatives. But for the prior 4 years, Republicans were doing that to shut down everything Joe Biden was doing. And in fact, Republicans started this when Obama was president. This wasn't a thing before Obama. And then Republicans discovered that they could put sand in the gears of political progress by doing this. And they have. It's become a new thing in American life. There's nothing in the Constitution that specifically says it's okay or that it's not okay. In fact, in Section 3 of the Constitution that defines the federal judiciary, the only court that's even mentioned in the Constitution is the Supreme Court. So all the federal courts are just things that have been created over the last 250 years by Congress. Now, someday, the Supreme Court may rule on whether it's constitutional or not for a judge in Honolulu to issue an injunction that stops an executive order for the whole country. Maybe. That hasn't happened yet. But in the meantime, the tariffs have been stopped by the courts. Except it's even better than that. That is, in civics class, there are these 9 districts, these 9 federal districts, geographically distributed. But the court that stopped the tariffs isn't one of them. There's a 10th district. It's not called the 10th district. It's called the federal district. And it does, by statute, power of Congress, have national jurisdiction without question. And the court that struck down Trump's tariffs is the Federal Court of International Trade. That's been around for 150 years. It's got this courtroom down by the harbor in New York, which used to be the center of the world's trade. So it used to be that a ship would come into New York Harbor and come from Scotland and it would be full of salmon. And let's say there was a mistake and the Customs Bureau tariffed the salmon at the higher tariff rate for cod. Well, you needed a court you could go to straighten that out. Government doesn't always get it right. Plaintiffs need to have a court where they can go to protect themselves from their government. In trade matters, that's why this court was established. And so there are people who feel that Trump doesn't have legal authority under the International Emergency Economic Powers Act of 1977 to assess all these tariffs. So Trump's 10% baseline tariff on the entire world and then all these additional so-called reciprocal tariffs were all justified by this statute, which passed in 1977. And this statute is only 3 pages long. You can just do a Google search. You'll get it on the first hit. You can read it. You don't have to be a lawyer to read it. This was 1977. When bills weren't 3,000 pages, they were 3 pages. And ordinary people like all of us on this call can read them. So I've read it. This law is like the Constitution. It gives a list of things that presidents can do. So if there's an emergency, the president has to formally declare a state of emergency. You can do asset seizures of foreign nationals. You can do sanctions. These are some of the things that have been done against Iran over the last 20 years. Does not mention tariffs. But Trump uses it first time ever, first time he's ever done it, first time any president's ever done it, has used this 1977 law to lay tariffs. Well, of course it's going to get struck down. It got struck down unanimously by the 3-member panel that heard it, including his own appointment to that court. So the very next day, it went to the appellate level in that same federal circuit. The appellate court in that circuit is overseen by Chief Justice John Roberts, but it's not the Supreme Court. He's just kind of their supervisor. It is a 12-judge circuit. 8 of them were appointed by Democrats. 4 of them were appointed by Republicans. One of the Republicans is 98 years old, appointed by Ronald Reagan, and she's completely senile, and it's a lifetime appointment, and she can't or won't resign, but she won't be on the panel that makes this decision. So it's going to be 3 Republicans versus 8 Democrats. They're going to decide on Trump's tariffs. How do you think this is going to turn out? Don't all speak at once. This appellate court is going to uphold the lower court in finding these tariffs unlawful. And then it's going to go to the Supreme Court. And they will unanimously find these tariffs to be unlawful, even though 6 of them are Republican appointments and 3 of them are Trump appointments. All of Trump's appointees will vote against Trump on this. Why? Because you remember in the first term, you may love this or you may hate this, but his philosophy in appointing Supreme Court justices is I want to appoint people who will actually read the law and enforce the law, not people who will find things that the government can do that are a good idea but aren't permitted by law. I want originalists. I want people who go back to the original text. That's what I did. The word tariffs isn't in this original text. The tariffs are dead, folks. Now, this same thing happened to Joe Biden 2 years ago when he tried to forgive $1 trillion worth of student debt. Got all the way up to the Supreme Court, and the Supreme Court said, no, you don't have the power to do that. Nice try, but you don't have the power to do that. And Biden came back with some other ways to do a little bit of it, but it wasn't $1 trillion anymore. It was, 10 billion here, 50 billion there. Oh, those are nice numbers. I'd love to have that kind of money in my IRA. But in the grand sweep of things right now in the federal government, that ain't nothing. That's what's going to happen to the tariffs. Everybody stop worrying about these tariffs. It's over. It's gone. Tariffs are taxes. Tax hikes are anti-growth. New tariffs are tax hikes. I hate tax hikes because I like growth. Don't worry about it. It's a solved problem. Now, at the same time, remember tariffs are taxes. There are other things going through the system of the government that are tax cuts. Now, the House and the Senate are both working on a big tax bill. You know the one. It's called the One Big Beautiful Bill. Yeah, did you know it's actually called that? Download it, read it. That's the official legislative title. You just got to love our world nowadays. One Big Beautiful Bill. There are lots of tax rates that were nice tax cuts from 2017 for individuals and corporations that are expiring on the last day of this year. Almost all the corporate stuff was legislated permanent in 2017, but almost all the stuff for individuals, like the estate tax exclusion, the top personal rate, the bracket at which the top personal rate kicks in, all that expires. And we fall off a fiscal cliff, and there's a giant tax hike. So that's what the Congress right now is trying to keep from happening. They're trying to rescue us from that fiscal cliff. They're trying to extend the expiring provisions of the 2017 tax cut. Oh, but wait, it's way better than that. They're not just extending them, they're making them permanent. Now, how often have we heard this year, oh my God, the uncertainty. Oh, the uncertainty. We don't know what's going to happen at the border. We don't know what's going to happen with the tariffs. Even if it all works out okay, oh my God, just the sheer uncertainty, help me. Well, here's a move in the direction of certainty. We're not just going to extend those nice lower tax rates for everyone on this call and for our estates. We're going to make them permanent. So we don't need to worry about this in the future. Now, I know there's nothing permanent in Washington. Congress can always get together and change it. But when a tax provision automatically expires on a date certain, well, now you have to do something to actively intervene to not fall off that cliff. At least if you legislate it as permanent, now you have to do something, actively intervene to make it go wrong. So this is a huge move in the direction of goodness. Everyone on this call is going to benefit from this. Now, in addition to that, they're adding all kinds of new tax cuts. They're not just extending the status quo, which is great, but that doesn't give anybody any more money. It just keeps you from losing money. That's good. Even better, new tax cuts. Now, you've heard some of the silly ideas. Like one of the ideas is to make it so there are no taxes on tips. I'll bet there are a lot of people who are going to figure out a way to turn a lot of their income into tips. But let's say they come up with a way to prevent fraud. Uh, that's just pandering. That's just a silly idea. That's the idea that somehow bartenders are better than lawyers and they should be taxed in more favorable terms. Silly. On the other hand, there's some really good things. How about the idea of not taxing overtime pay? Well, that may be taking things a little bit far, but think about the incentive effects. Overtime is for hourly workers. So we're not talking about, lawyers and doctors and surgeons. We're talking about ordinary blue collar working people who are paid by the hour. They work an 8-hour day. Their boss wants them to put in some overtime. So you get paid, 1.5 times your hourly rate to do that. So you already have an incentive. But I think everybody on this call knows that our tax code is set up so the more money you make, the higher a rate you pay on every additional dollar. If you've already put in an 8-hour day at a blue collar job, putting in that 9th, 10th, 11th, and 12th hour is brutal. You're tired, you want to go home and kiss your wife and feed your dog, but your boss wants you to stay and he's going to pay you extra for it. Except Uncle Sam is going to tax you more for those extra hours than it did for your base hours. And those extra hours are the hard ones for you to put in. So you're being punished to do the right thing, to do the hard thing. Well, they're going to fix that. Tremendous incentive effects. Now, for employers, that's fantastic because employers love it when their employees are willing to work overtime. Why? Because you get to control your head count. You get to more hours worked with fewer heads. It's the head count that drives your costs in a business. If people wouldn't work overtime, you'd have to hire all kinds of new people to work those hours. You don't know whether they're going to work out or not. They're not tested. They're new people. You got to train them to have any hope of working out. So it's like 2 years before they're productive at all. This is great tax policy. So there's some good tax policy like that. There's some bad tax policy like not taxing tips. But there's lots of it. It all adds up. And if you take the total value of the tax cuts and compare it to the total value of the tax hikes represented by the tariffs, they about offset each other. And that's assuming that the courts end up not intervening and the full boat of tariffs goes through. So one of the reasons why stocks are up a little bit this year, despite all this uncertainty, is there's some terrible tax policy going on called tariffs, and there's some really good tax policy going on called extend the 2017 expiring provisions called new tax cuts, and they happen to be perfectly balanced. So it's this equilibrium. balancing act. It's a little bit fragile, but right now it looks like it's breaking down in just the right way. It looks like we're not going to have the tariff tax hikes, but we're still going to get the tax cuts. So I think it's a very, very optimistic outlook. Why don't we see what's on the next page? Joe, there we go. Um, we have a Fed meeting tomorrow, and the Fed is not going to cut interest rates tomorrow, but they're going to have a lot to say about what they might do about cutting or not cutting interest rates for the rest of the year. And I'm sure you've or heard them say, if you maybe you follow them in detail like I do, or maybe you just hear the headlines every time they meet every 6 weeks. But uh, they're saying they're really worried about inflation, and we need to keep interest rates higher than we would have otherwise because of our worries about inflation. Why are we worried about inflation? Because of tariffs. Well, everybody knows that tariffs cause inflation, right? Because Walmart has to pay a tariff that it wasn't paying otherwise. Well, Walmart's not going to accept lesser profits. It's going to just increase prices on the shelf, aren't they? That'll cause inflation, won't it? So we have to have high interest rates. Well, you might want to take a look at these charts on these pages. Uh, the one on the left, the big one with just the two simple the blue line and the brown line, that's going all the way back to 2018. That was Trump's first tariffs in his first term. He imposed a 25% tariff on imported steel and a 25% tariff on imported aluminum. And these are the prices of imported steel and imported aluminum during the time of those tariffs, up until the pandemic hit, at which point nobody was buying aluminum or steel for a while. 25% tariffs. Now you'll notice in the case of steel, prices went up by about 12%. In the cases of aluminum, they went up by about 6%. And then a year later, prices were lower. How the heck did that happen? I don't know, but it did. So, yes, it's common sense that tariffs ought to raise prices, but in investing and in markets and in economics, common sense isn't usually your friend. Look at the data, look at history, look at what really happened. Prices didn't go up. Now, we can do this with the whole economy over the same period of 2018 and 2019. We had very high tariffs on China imposed during those 2 years. And that was when China was our largest trading partner. They're not anymore. Mexico is. Now, that should show up in CPI, shouldn't it? Overall inflation, stuff you buy. It didn't. It didn't. It's not just like the tariffs had a temporary, like one-time effect on the price level while they got absorbed and then there was nothing more. No. During the years of 18 and 19, 2018, 2019, and the first part of 2020 before the pandemic hit, there was not even one single individual month when CPI was noteworthy. So we've kind of run this experiment. So this is like when doctors have a new drug and they test it on mice. So we can go back to 2018 and 2019 and say, okay, those seemed like big tariffs at the time. They're not as big as the ones Trump is trying to impose now, but we can look at that as a test. That can be like our mouse. The mouse is fine. There was no inflation. There was no recession. Everything was fine. So are we doing it bigger this time? Maybe. Well, we haven't heard what the Supreme Court has to say yet, have we? Now, the Fed seems very, very engaged in these ideas. The Fed is tracking potential Trump policy and its economic effect, not only tracking it, but anticipating it before it even happens, before the courts even render their judgment. They've never done this before with economic policy, ever. I've been tracking the Fed for 45 years. There's never been a case in which the Fed looks at economic policy that's forming and pre-anticipates it into its own monetary policy. 4 years ago, when Joe Biden was in the kind of the same position in his term that Trump is in his, Biden was promoting his own big tax bill. And it had the same initials, BBB. It wasn't Big Beautiful Bill, it was Build Back Better. That was going to increase taxes by $4 trillion. $4 trillion. You know how much the tariffs are going to increase taxes? 200 billion. Teeny, teeny little piece of that. And the Fed's absolutely whipped into a frenzy about that. And they literally never even mentioned what Biden was trying to do. And it's all because Donald Trump is a very unique person. You can love him, you can hate him. Some combination of the two. It's up to you. But he makes it so you can't ignore him. And all those smart, wise men and women on the Fed, they are unable to ignore him. They're absolutely obsessed. So we will see what happens tomorrow. But the reality is, we still have room to cut rates. It's not an emergency like it was, a year ago, but that's because they've already cut rates by 100 basis points. So it's probably not all important what the Fed does tomorrow. They will do nothing. But what's important is what they signal that they're going to do for the rest of the year. And if they signal that they are ready to throw the economy into recession in order to, I don't know, somehow respond to tariffs, I mean, it's not clear how that would even work. That would be a problem, but they're probably not going to do that. Let's turn to the next slide, please. Um, Corporate earnings, uh, you have to sort of wait and see what they're going to be. The companies have to make their earnings and they have to report them. But Wall Street is very busily engaged in forecasting earnings, and you can get good, high quality earnings forecasts for all S&P 500 companies out 8 quarters, 2 years. And the orange line that runs from the bottom left to the upper right in the top chart on this very complicated page shows you the history from 1982 of S&P 500 forward earnings anticipated out 1 year at a time from every point in that chart. And you can see that it's a beautiful, beautiful success story of earnings just moving up and to the right, up and to the right, up and to the right. And every once in a while, there's a little fluctuation, and we call those recessions. This is a very, very good recession indicator. When forward earnings, when expected earnings roll over, there's recession coming. Some people look at the yield curve, you've probably heard, to predict recessions. That doesn't work so well. This works really, really well. Now, we have not had a big rollover in forward earnings despite this huge tariff threat. We have had a flattening out, and that's the beginning of a warning sign, perhaps. I'm choosing my words very carefully. It's the beginning of a warning, right? So it's a precursor of a precursor. Yeah, so the hammer hasn't fallen here at all. And again, I don't think it will. The Supreme Court's going to rule out all this stuff. But at the moment, we are having a little bit of a fluctuation, a little bit of a disappointment, a little bit of a flattening in expected earnings, which is not to say that Wall Street is forecasting or that it'll actually turn out that corporate earnings are flat. That's not what this chart is showing you. What this chart is showing you is what people think every day is going to happen a year from today. And we just want them to think every day that it's going to be a little better than they thought it was going to be yesterday. Then tomorrow, they'll think it's even better than that. That's what we want to see. And when they just hold steady, when they say, on Monday I thought it was going to earnings were going to be 100, and on Tuesday I still think earnings are going to be 100. Is that so bad? No. But I wanted you to say on Tuesday that earnings were going to be 101. That's what we normally get. That's not what we're getting. So we are, that's why the whole S&P 500, including the Magnificent Seven, is a little bit up this year, just a couple percent. It's basically unchanged. That's because earnings expectations are unchanged. I expect that will improve quite sharply and quite quickly as soon as we hear from the Supreme Court. Let's look at the next chart. This top chart, I'm not going to cover this whole page at all, just this top chart. The blue bands and the red bands are taking you all the way back to the mid-70s. Those are presidential administrations. The red ones are Republicans, the blue ones are Democrats, and the white squiggly line that looks like a heart monitor is the Small Business Optimism Index. And you can see as a general matter that small business optimism is better under Republican presidents than it is under Democratic presidents, but not without some exceptions. Right in the middle of the chart, you have some very good small business optimism in that big blue band, those 8 years when Bill Clinton was president. He was a very business friendly, small business friendly president. He had a great attitude. He was kind of like Trump. He's kind of like a P.T. Barnum, salesman type. And the small businesses who really make up the backbone of the US, and as investors, we tend to ignore small businesses because they're not publicly traded and we can't directly invest in them, so we don't have any skin in the game. But make no mistake about it, they're the broad back on which the economy stands. More than half the jobs in this country are with companies with fewer than 50 people. It really matters what small business thinks. Oh, sure, it matters what, IBM thinks too. But there's just one IBM, but there are tens and tens of millions of small businesses. And they respond to a cheerleader like Bill Clinton or Donald Trump. Well, as you can see, over toward the right there, that last blue band, that was the Biden band. They didn't like that so much. And they didn't like Obama so much. That was the previous blue band. But as soon as Trump was elected, small business optimism just soared. So when the tariff threat clears, and trust me, it will, this is going to be the energy source that's going to power up the very foundation of this economy. And all the stocks you invest in, believe me, they rest on the platform of these tens of millions of anonymous little guys. So this is really, really important for the future of your portfolio. Let's look at the next chart.
Hey, Don.
Yes.
Yeah, Don, actually, if we could hang out here for a quick second. You've got a chart on there about the U.S. Treasury debt.
Mm-hmm.
That's on clients' minds right now. I think we're at $38 trillion, and you've
Mm-hmm.
got the famed hedge fund manager that did very well for many years, Ray Dalio, screaming about the debt wall and the debt crisis. You've got Jamie Dimon, who is a tremendous banker, but not so much of a great prognosticator, according to Scott Bessent, the Treasury Secretary. He's very critical of the debt levels. I don't know if we're coming back to the debt, but you were talking
Well,
about the big beautiful bill. I read a headline said it's going to add 5 trillion to the debt, and on top of 38 trillion, seems like a lot. And I know in our conversations in the past, you've said don't get so myopically focused on one side of the balance sheet. The country has a lot of assets also, whether it's mineral rights, whether it's real estate, whether it's future tax revenue brought to a present value. You don't seem to be as worried as Jamie Dimon, Ray Dalio, or the average American about the debt levels. Can you just
well,
comment on that?
I'm not in for two reasons. One, as a person who has a little bit of a media profile. I mean, I certainly don't have what Jamie Dimon or Ray Dalio have, but anybody who's in the media uh, needs to get your attention. And the best way to get your attention is to call something a crisis and say it's going to be the end of the world. Everybody suddenly that just rivets everybody's attention. So everybody think back to when you were really young. Think of some of the things you said like on first dates in order to get attention. And when we watch Ray Dalio and Jamie Dimon, just think of that in mind. Remember, he's trying to date you, right? He's just trying to get your attention. So just throw that stuff out. I want to bring in an expert witness who knows so much more about this than those two men. I call to the stand Mr. Market. Mr. Market, what is the yield on 10-year treasuries right now? Sir, it is 4.39%. If we were facing a debt crisis, what would the yield on the 10-year be? 40.39%.
Mhm.
4.39% is so far below average for the 10-year yield on treasuries in this country that, if anything, it's telling you we ought to have more debt.
Hmm.
Now, I'm a libertarian. I want a small government because I think government is intrusive and inefficient and corrupt, and I want less of it. So I want less government debt. I want everything about government to be less. But am I worried that we're going to just face some kind of incredible implosion and bankruptcy and all that jazz? Absolutely not. So, Tony, you said it yourself. The amount of debt you have is either sensible or unsensible. It's either fine or it's dangerous in relation to who you are. If you're a billionaire, you can have $100 billion in debt, say, and that'd be just fine. That'd be very little debt for a billionaire, right? On the other hand, if you're just an ordinary working guy, it can be 20 or $30,000 in debt that'll kill you. You've got to put it in
Hmm.
context. You mentioned many assets that the United States has. Its most important asset is its taxing power. Not just its taxing power today, but its taxing power out to perpetuity as the economy grows, because that's how you service the debt. Sure, outstanding treasury debt's in the high 30s. The market cap of the S&P 500, which represents the earnings power of corporate America, reduced to a present value, well, that's where your taxing power is. That's 53 trillion.
Hmm.
So let's say you were trying to get a mortgage from a bank. And you say, I want to borrow $38. And the banker says, okay, what's your house worth? 53. Okay, no problem. Would you like to borrow more?
Makes sense. Makes sense. Don, how do we pace the rest of our conversation here? I'd like to ask you about Doge, and I know you have a slide on that. That was in the headlines a while ago, and there were optimistic forecasts that we could cut $2 trillion out of government spending or waste, fraud, and abuse. And I think we came in at 10% of that. People were worried about a lot of government employees being thrown into the labor market, unemployed. Joe, do you want to find that chart? Maybe Don can share a little bit about a Doge update and the impact of that. There
There
we
you go.
go. Is that okay,
All right,
Don?
yeah, I mean, good luck understanding this chart on this little screen. But what this is showing you is ever since Trump took office, what is the joblessness that has occurred in every state and the federal government. So there are 51 bars, and every state gets a bar, and the federal government gets a bar. Uh, if you put the federal government plus Washington, D.C., Virginia, and Maryland all together, then ever since Trump took office, the total joblessness has only been 2,000.
Hmm.
Now, that isn't to say we just don't know. That isn't to say only 2,000 people have been fired from the federal government and from local entities that feed on the federal government. But what it does mean from the macroeconomic perspective, which I think is really why we're all here, is it means that even if way more than that were fired, a whole bunch of them got rehired. So what we want to know for economic terms is what is the net, right? It's one thing to say we fired X people, but if we rehired 0.99x, well, that's pretty good. We've got a booming economy where the unemployment rate is about 4%. So if you're a worker, say in Maryland, this would be a really good time to lose your job because there's never been a better time in history to get a new job. And that appears to be what's happening. Now, on the other hand, so that's my macroeconomic analysis. You remember when Trump first took office and Musk was doing what I say Jamie Dimon does. He does things to get your attention. And so he throws, $2 trillion out there. Well, the entire discretionary federal budget is only $2 trillion. So that was, nobody should have believed him anyway. But they delivered on a teeny little fraction of that, and that's disappointing if like me you want to cut the scope of government. But all you heard back then is, oh my God, they're going to cause a recession by firing all these people. Well, no, that didn't happen either.
Hmm. Makes sense. I want to talk about, Don, you've got some slides, housing and the supply chain. It's such a critical part of people's net worth. And, we thought the housing market would slow down with mortgage rates approaching 7%. It's hard to get out of a house when you're paying 3.5% on a mortgage to trade it for a new one at 8%. Does
Yep.
this slide on the left speak to that?
Yeah, what this slide on the left is showing you is just showing the total dollar value of housing transactions. And so you see that there are two big surges that you see in the chart. Over, toward the left, you see the crazy housing bubble that led to the great financial crisis and Lehman and all that stuff. But then you see an even bigger bubble toward the right of the chart, which was the pandemic, when the Fed made it possible for everybody to refinance their mortgages at 3%, and the lockdowns made it desirable to move to sunny places where they weren't quite so draconian with you. So we saw a huge amount of housing activity, so much of it that one could have reasonably expected in the aftermath there'd be a housing recession. But as you can see from this chart, after that housing bubble burst, there was no recession. We're just sort of growing transactions in both new homes, which is the green chart, and existing homes, which is the blue area, are just growing at the trend that they were growing before the pandemic. So that's great that you can have that huge revolution in housing, and then just come out of that with no hangover. It's really quite remarkable, and it's been 3 years. And if we were going to have a bad hangover, we'd know it by now. And I think there are a lot of reasons for it. Certainly what you just said, which is those who refinanced during that window that the Fed gave you to do that, are, to some extent, the captive of their wonderful financing. But on the other hand, you've had so much appreciation in the value of your home that while it's difficult to leave that financing behind, you can sell your home for a price that would just have been a dream come true any other time. And you can then take that capital and use it to buy another home and have a smaller mortgage.
Mhm. Mhm.
So this is complicated, but the bottom line is it's just fine. This is so I think a question that one should have asked when the housing bubble of the pandemic ended is, does this mean we're going to have another Lehman style financial crisis where we're going to have to go through 2 or 3 years when I just can't sell my house and it'll be a disaster? No, 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 that didn't happen.
Don, I want to get your opinion on the market, where markets are cheap, where markets are expensive. Joe, risk premiums, US and China. Don, are you making any allocation changes to your portfolio as a result of what we're looking at here?
Uh, no, I'm not. And I want to caution everybody to understand that, there are, it's not a caution, it's just a little axiom. Um, broadly speaking, there are two investment philosophies. There's the growth investment philosophy, where you identify companies that you think are going to have superior growth in the future based on efficiencies or association with new technologies like Bitcoin or AI or whatever it is. And then there's the value philosophy, which is you don't really care what the companies do, you just want them to be cheap. Now, if you could somehow marry those two philosophies and get growth companies at cheap prices, I suppose that would be a dream come true, but it doesn't generally work out that way. Now, the US market is not cheap. It is not cheap. The Chinese market is cheap. Now, the Chinese market is a place where, by law, you don't have any property rights. Do you think that's why stocks might be cheap there? Because you don't really own them? Well, that's worth considering. It's worth considering that the Chinese economy doesn't have any real growth prospects anymore because, after all, its stock market topped out 11 years ago. 2014. China's been in a bear market for 14 years. Excuse me, 11 years. So, yeah, it's cheap. But, I'm still waiting. Now, the US, on the other hand, while China has done its best to just, imitate us as best as it can and use all kinds of tricks to prop up its economy, we invented cryptocurrency. We invented AI. Oh my God, are we good at this? It's really amazing. And yeah, I know that as you said earlier, Tony, in the first half of the year, it's been a very wonderful little window when non-U.S. stocks, at least in many parts of the world, have outperformed. But it's kind of been a case. It's kind of been a time when value did better than growth. But
Mhm.
when you look at an Nvidia or a Tesla or a Microsoft or a Facebook, you've got to say, I don't know whether these stocks are overvalued or undervalued. And it doesn't really matter. I'm betting on their ability to implement these amazing new technologies, in which case they're just worth anything. Now, you could ask a whole different kind of question. You can say, okay, well, I think I understand Walmart's business model pretty well. Walmart's PE is 35, right? Walmart's got a Magnificent Seven type PE. I think within the Magnificent Seven, only Tesla has a higher PE ratio than Walmart.
Mhm.
So you want to find cheap things in the American market that also have growth prospects? Well, I'll just, I don't know, this is Tony's job to think through for you, but I'll just tell you my opinion. I would look in two sectors. I would look at energy and I would look at banking. Those are the two cheapest sectors by PE, and those are the two sectors which, under the Trump administration, love him or hate him, you can love what he's doing over here, you can hate what he's doing over there, but what he's doing for the energy sector and the banking sector is a massive headlong dash to deregulation that is going to liberate them, improve their profit margins, and give them growth potential that they haven't had for years, even under his first administration, because he didn't know what he was doing then.
Mhm.
And they're the cheapest sectors.
Mhm. Terrific. If the inflation threat from tariffs is going away because of a Supreme Court ruling, we've had constraints on energy because of the Russian sanctions. And I believe there's sanctions on Iran also, but they seem to be selling most of their oil to China at a discount. And now we've got the latest oil shock, and who knows if Iran, who seems to be begging to get back into the nuclear talks, if they're going to close the Straits of Hormuz. Yeah, we can drill, baby, drill here, but what about the global energy situation? What do you see in this chart, Don?
Well, if we have what this chart is doing is the top chart is this is the volume of Russian oil that's being moved on ocean, and first Biden and then Trump and all the Western nations have tried to put sanctions on this to prevent it in order to cripple their war-making capacity, but you can see it's just completely ineffective. Uh, the U.S., Russia, and Saudi are the top three oil producers, and Russia and Saudi are the two top exporters, and Russia just seems to be unstoppable. And if you want low oil prices, that's a good thing. If you want to starve Vladimir Putin of his war chest, then you're not so thrilled about it. But this is the reality. Um, the risk of Iran doing something sort of in cornered rat mode, and sort of just before they run up the white flag and admit defeat, they do something desperate like take a big super tanker and sink it sideways in the Straits of Hormuz so no oil can move there. Okay, that's gonna be a little disruption, but
Mm.
it's it's pretty easy to clear those boats out of the way. So I know there's a measurable and meaningful potential that they could just do something to knock out Saudi refining capacity, or there's stuff they can do that would be annoying for a couple months. But remember, Iran has been under sanctions for years and years and years, and they are capable of producing about 4 million barrels a day. They're only producing three. They use 2 million a day for their own economy. Iran is a weirdly large economy. It's the largest economy in the Middle East, and they export about a million. Now, if Iran were to be decimated by bunker busters, then that would be a million in exports that would come off the market. You know what Saudi Arabia's swing capacity to produce is? 3 million.
Huge.
So this is just not a problem. This is just not a problem. So I'm going to editorialize here. You know what's a problem? It's a problem for Iran to have a nuclear weapon.
Mm-hmm.
So we are passing through a moment here where we're taking some risk in order to eliminate a truly existential cosmic risk that hangs over the entire planet.
Excellent. Well, Don, we're going to stick the landing on this at 1 o'clock. I have one question that came through the chat, and I had a similar question. I'll give you the question. I'll give you a slight modification. There's been a lot of articles on China's supplies of raw materials. Does that
Yes.
change any of that outlook over the long term as they control that supply?
Right.
And the things that come to my mind are these rare earth materials for
Yes.
robotics and electric cars and cell phones,
Yeah.
and then the
Yeah.
pharmaceuticals. I have some number as high as 80% of our pharmaceutical compounds come from China. I don't know the real story there,
Yeah.
but what say you?
Um, what say me is that this is sort of analogous to the Iran thing, where all the risks are in the short term. Um, the the hold that China has on the rare earths elements markets is strictly economic. These elements like praseodymium they're in every country in the world, and the larger a country you are, the more you have of them. And the problem is they're just very polluting and annoying to process. And over the years, we've delegated that to China because it's better for our environment here in the United States, and they'll do it with slave labor. So that's a deal with the devil that we made that we're going to have to deal with. But if if we were to get in a true trade war with China and they were going to just cut off all our praseodymium, uh, we'd have our own sources back within 6 months. So there might be 6 months when there wouldn't be as many Teslas on the lot as you might like, but it's a 6 month problem. Uh, Pharmaceuticals, same thing. The whole world knows how to make them. It's just that China just underprices everybody. So we've just all gotten addicted to buying the lowest price. Um, there could be disruptions there too. I'm not saying there won't, but you were asking me what the long-term prospects are, and the long-term prospects are absolutely excellent. It's very easy to replace a supplier if you just wait 6 months. The problem is getting through those 6 months. We get 40% of our antibiotics from China. So if those were just to have a hard cutoff, people would die. People would die.
Mhm.
They won't be dying a year from now, but there'll be 6 months during which people will die. Now, what's the definition of a war? It's when you do something that makes the other side die. So cutting off our antibiotics, that would be war.
Yeah. Well, good, Don. 1 o'clock here. I'm just going to summarize a couple things that I noted. Supreme Court is going to decide on tariffs, and likely that they're not legal. No Fed rate cut tomorrow. Small business is optimistic, and that's a really good sign. Don't worry about the debt. The asset side of the U.S. balance sheet is tremendous, and a 10-year yield slightly above 4% is not signaling any kind of calamity. China is cheap, but but we're still waiting. The U.S. is a growth stock and is priced like one, and your favorite sectors are energy and banking. So, Don, I
Tony,
want to
that
thank you.
wait, that was so good. Was that you or was that AI?
Really bad handwriting, but I can read my own handwriting. Don, I want to thank you for being with us. We're going to have you back in the fall where we will again
Great.
take a look back and a look forward. You're the best, Don. Thanks for your
You're the
time today,
best.
and thanks to everybody that
Thank you.
joined.
Thank you.
All right.